Joining me now, Anthony Pompliano, founder and CEO of Professional Capital Management. On set, great to have you. So much to talk to you about. But of course, we are going to start with Bitcoin because it has been outperforming over the past week.
Well, I think there's a couple of different things, right? One is Bitcoin is a resilient asset that is really serving as global insurance. And so anytime that there's chaos in the world, there's going to be people who run to Bitcoin. Gold also serves as that use case. But I think that more and more people, especially as young people get a little bit older, they get a little bit more money, they start to go and they buy Bitcoin in times of uncertainty. And I think institutions also, what is misunderstood is that in the institutions, the young people 10 years ago, they're now rising to the role of the portfolio manager or the CIO. And so they also will start to continue to add Bitcoin into their portfolios as well. And I think you see Bitcoin performing pretty well given what's happening right now.
And yet, gold has not performed particularly well over the past, call it, week.
Well, if you think about what's gone on over the last year or so, pretty much everyone who's going to sell Bitcoin off of the highs has pretty much already sold, right? Everyone who's going to buy gold has pretty much bought. And so I think that you saw two assets that diverged, and these two assets, they serve as a store of value. And I know that the gold bugs have been doing their victory lap for the last year. I like gold. I don't hate gold in any way. But I do think that Bitcoin is a 10x better asset in terms of it is more divisible, it is more mobile, it is much more resilient than gold. And so I think that over time, what you're going to see is you're going to see more and more capital flow into Bitcoin. And look at the ETFs. What took gold's ETF 15 years to do, Bitcoin has done in less than 2. And so I think that just naturally you're seeing the rapid adoption of an asset. Now, it is going to be volatile, and I think people love to celebrate when Bitcoin falls. It's down 50%. Well, if that was the bottom of the bear market is just a 50% drawdown, then it's the best performing bear market of all time in Bitcoin's history. And so let's see what happens.
Interesting. Do you think then, in light of that and what we're seeing with Operation Epic Fury, that Bitcoin is shifting gears in terms of how it's trading? Because the conversation had been that this is, a risk-on asset. It's trading as such. It's a liquidity indicator. It's not a store of value. Do you think that this is an inflection point?
Well, I think there is a very, very big misunderstanding when it comes to what's happening in the global economy right now, and specifically with inflation domestically. If you look at inflation expectations, people have been saying that we were going to get sky-high inflation because of the tariffs. And I was very loud about the fact that we were not going to get that. The tariffs were going to be deflationary. Now, if you look over the last year or so, what we've seen is tariffs are deflationary, deportations are deflationary, AI is deflationary, and robotics are deflationary. And we see this happening throughout the economy. And so the big risk right now is still deflation, not inflation in the U.S. economy. And I understand that oil has spiked in the short term, and people are going to freak out about that. This has been going on for 8 days, this Operation Epic Fury. And so let's say that it ends in the next 2 or 3 weeks. It would have been a short-term impact to oil prices, and the deflationary nature of what's happening in the economy is still a much, much bigger concern than a short-term oil impact. And I think what people also forget is that, take housing as an example. The government is still saying that housing prices are growing. Trueflation, which is a real-time measurement, is saying that housing is in deflation already. It's down 1.5% over the last 12 months. If that is true, housing is a much bigger input into the CPI calculation than, let's say, oil or energy is at around 5%. And so I think that people, it's very easy to get attracted to the headlines and the volatile oil price. But again, the structural thing that we are facing is deflation because of deportations, tariffs, AI, and robotics.
Yeah, and of course we get CPI and PCE readings this week, and this will be before any spike we've seen in energy prices. So we'll look at that according to your lines of thinking. At what point, though, if you have energy, if you have oil prices at these sustained levels, we know that funnels out into other parts of the economy. So at what point does that change, if it changes?
Well, if it's prolonged, right? If we end up going 6, 9, 12 months with really, really high oil prices, obviously that'll have a very big impact. The other thing that's pretty interesting, though, is that the U.S. dependency on oil as a percent of production, right? So if you think of like how much energy do we need to consume from oil specifically in order to produce 1 unit of GDP, that has been going down over time. We're actually lower today than we were, let's say, in 2007, 2008. There's some good research that's been put out about that. Now, it doesn't mean that we're not dependent on it at all, but I do think that people are still caught on this idea that if oil prices go higher, then immediately we get, higher consumer inflation, and I just don't see that happening in the economy.
All right, so let's put it all together. We've got a war in Iran. We've got a spike, at least for now, 8-day spike in energy prices. We've got AI disruption concerns. We've got cracks in private credit, and we have a weaker jobs report. How do you invest right now?
Buy Bitcoin.